Right. So now what this question, I'm sure this question may come in the minds of everyone. Where do the companies pay dividend from? So remember, companies will pay dividend from the earning after tax. So companies pay dividend from the earning after tax. So you have a earning after tax, and by the way, you know why it is known as EAT? Why it is EAT? It is EAT, EAT. That means what? That means if your company have a positive figure of EAT, then only you can eat and not otherwise. So this is how also one can understand that if you want to eat in your business, then you must make sure that your profit figure or EAT figure is positive. So it is from the EAT that you pay dividend. So let's say this company has earning after tax of 228. Company decides to pay dividend of 28, and what is left in the hands of the company is 200. Now this 200, remember, is known as retained earning, or you can also call it as retained profit. Retained profit. No rocket science. It is known as retained earning because you earned a profit of 228 crore. Out of that profit, 28 crore you have given to the shareholders as dividend. How much profit have you retained in the business? So you have retained in the business a profit of 200 crore, and that is why this is known as retained profit. Now please remember, this number is extremely important. This number decides growth of a business. This number decides growth of a business. Why? Because ultimately, how would a business will grow? A business will grow on the strength of the profit that it flows back into the business. Because if a business is not making profit, or making profit but not flowing it back into the business, no one is going to give you money. Lenders will not give you money for sure, and the equity shareholders, new equity shareholders, will also be hesitant to give you money. Why? Because you are not optimizing the profit that you are earning. Very simple. If company earns a profit of 228 crore, so this company has earned a profit of 228 crore. If this company gives the entire profit of 228 crore to the shareholders as dividend, please understand how much the shareholders would be able to earn on that 228 crore of dividend they would have received. 7%, 8%, 9%, 10%, isn't it? But if the company plows this profit back into the business, then company can generate a profit of 15%, 20%, 25% on this profit which it is plowing back. And therefore, please remember, it is very important to see that a business is plowing back a major part of the profit back into the business. That would determine the growth of that business going forward. Then you have something which is known as cash earning or cash profit. So how do you figure out the cash earning or the cash profit? So you take the figure of profit after tax. Please remember, ये आपने profit कमाया. This is the profit that you have earned. Please understand, you have depreciation. You have deducted depreciation from your income. But this depreciation or this amortization, you do not have given this money to anyone. You have not given this money to amortization to anyone. So this amount of depreciation and this amount of amortization is also there in the business. So that means, what is the cash earning of this business? Cash earning of this business is earning after tax plus depreciation and plus amortization. That means this is the cash that the business has got in the hands. So this is the amount of cash the business has got in its hands. Now, so this is your, this 200 is your retained earning. 303 is your cash profit or cash earning. Now what you have to do is, you need to find out the retained cash earning. So what is retained cash earning? This is the cash earning that you have, and this is the amount of dividend that you have paid. So what is the cash that you have retained in the business is 275. Is 275. So this is the amount which you have retained in the business for your future growth. How do we find out the earning per share? Now, all of you, please remember, earning per share is the most important KPI for any business. For your information, businesses all over the globe, the top executives of the companies all over the globe, be it in India, be it in America, be it in Europe, be it in Australia, New Zealand, Japan, China, anywhere and everywhere, are driven by one number, and that one number is earning per share. That number is earning per share. Meaning what? Meaning if the earning per share of a business is growing, that means everything is good with that business. Why? Because how do you calculate earning per share? You calculate earning per share by taking your earning after tax. So this is your earning after tax and divided by the number of shares that you have, and this is what is your earning per share, 222.8. This is your earning per share. Now, if this number is increasing, if the earning per share of a company is increasing, apparently this company is doing good. This company is doing well. Why all the CEOs and the MDs and the top executives, CFOs, plant heads, COOs, why are they driven by this one number? And that is because you would have seen, all of you, all these listed companies on the stock market, every quarter they have to disclose their results, publish their results in the newspapers and also in the media. And also they need to upload it on the website of the SEBI and also on their respective websites. You would have noticed whenever the earning per share of a company is going up, by default, invariably that would happen, the market price of that company's share also would have gone up. Now, what does it mean? It means the wealth of the share also has gone up. What is the wealth of the shareholders? Wealth of the shareholders is nothing, number of shares they hold in that company into the market price of the share of that company. That is the wealth of the shareholders. So when the EPS goes up, the wealth of the shareholders go up. And when the wealth of shareholders goes up, then what happens? The shareholders feel happy and they give bonuses. So the bonuses of the top executives across the globe are linked with the earning per share. And that is how all over the globe, the top executives are driven by earning per share. So an MD of a company, CEO of a company, COO of a company, CFO of a company, his prime focus is going to be on the EPS, because ultimately how the business is going, it will reflect in the earning per share. Then you have something which is known as cash earning per share. And how do you calculate the cash earning per share? So you take the figure of cash and divided it by your number of shares, and this is what you get, your cash earning per share. That means profit that you have earned is your earning per share. Cash that you have earned, that is your cash earning per share. So not only in your business, remember, it is important to know what is your earning per share. It is also important to know what is your cash earning per share. Why do I say this? That is because for a new company, remember, for a new company, what is going to happen? The profit may be less. And why the profit is less? Because new company hai, they have a lot of assets. So that's why they have a high amount of depreciation. Since they have a high amount of depreciation, that is why their EPS is depressing, because your profits are depressing because of the high depreciation. So depreciation, as we discussed, is a non-cash expense. The money is not going out. The money is still in the business. So if it is still in the business, that the business can use this cash for whatever purpose they want to use it for. So that is why you also look at your cash earning per share. Then you have something which is known as growth earning per share. And how do you calculate growth earning per share? You calculate growth earning per share by taking the retained profit divided by the number of shares, and this give you your growth earning per share. And why do I call it growth earning per share? Remember, growth of a business will depend how much profit you plow back into the business. So the profit that you plow back into the business will enable you to expand, to diversify, to modernize, right? And that is why this figure, this is your growth earning per share. And then of course you can also calculate growth cash earning per share. And how do you calculate this? So you calculate your retained cash earnings divided by the number of shares, and this is what will give you your growth cash earning per share, right? So this is how, friends, you will calculate your profitability and profit for the purpose of decision making. Remember, as the business owner or as a company, you do not have to publish this profitability for the benefit of shareholders. This is only for the purpose of the management, for the purpose of taking decisions, right? So with this, I think we can again take a pause, and in case if anyone has any question, we can take all those questions, and then we will move to the balance sheet.
Sir, I think there's one